Financial markets, you can tell, are schizophrenic at the moment. With every new inflation number, employment statistic or economic growth projection, equity, bond and currency markets, well, they boil and bubble, don't they? Now, take Dan Kemp, the Global Chief Investment Officer at Morningstar Investment Management Group. In recent weeks, his research headlines, have a look at these. They read, stocks are looking cheap again. That was in April, and in hindsight, he was right. There's also, will the new inflation story hurt stocks? What fewer rate cuts could mean for stock valuations and central banks' inflation and patient investing. Led Boyd spoke with Dan Kemp from this week's Morningstar conference in Sydney.
Oh, Ed, you're absolutely right. Everyone is so fixated on what's happening in the short term. They're fixated on what central banks are doing, what's happening in currency markets and geopolitics, and all the things that we see around us that are really just designed to distract investors. Investing is always about the long term. It's always about what's really happening in companies and in asset classes. And it's not really about the day-to-day noise that we see in the market. So it's a difficult time for investors because we're bombarded by this noise all the time. It's making prices quite volatile, but we just need to do the best we can to look through that into the future.
Yeah, you released a report back in April basically saying stocks are starting to look cheap. You've been proved correct with that prediction. Markets are up strongly, close to record highs. But what could potentially bring them back down to earth?
Yeah, well, that's a really excellent question because we always have to be thinking about the risks that there are around us. And one of the risks that we see at the moment is that the investing community seems to have moved very quickly from expecting inflation to stay quite high and interest rates to stay quite high to now expecting them to fall. And that really reflects comments from the US Central Bank and others about expected declines in interest rates. And so if we have stickier inflation than we're expecting, if actually interest rates stay high, then that could be a dent to the confidence of investors. And that will create some volatility if that happens. But again, it's just a little bit of noise. We know that inflation's come down from a high that we saw a little while ago. We know that a lot of companies are in fairly good shape. We're getting good reports. And so it's important that we don't get too over-optimistic when we're getting this positive economic news and then don't become too pessimistic when it comes the other way. So expect this narrative to evolve over time. But again, the more we can block it out, the better.
Yeah, US consumer prices and consumer prices in England definitely on the way back down. But it seems like there's almost an expectation that there could now be fewer rate cuts by the US Federal Reserve. What could that possibly mean for equity valuations?
Yeah, Ed, that is the concern that's buzzing in the minds of investors out there because people came into this year expecting, in some cases, 6 interest rate cuts of a quarter point over the course of the year. That's gradually getting pared back as we work through the year. And of course, that's most damaging to companies that are dependent on debt or where their earnings are in the far future. And so some of the cracks in confidence we're seeing are in some of those large technology companies where so much of their real value comes from the growth that people are expecting into the far future. If it looks like that growth may be imperiled and we have higher interest rates, then we can see a little bit of a decline, a little bit of a crack there in confidence. So we might be seeing a bit of a change in terms of market leadership. And again, that reflects the ongoing emotional change we have in markets. And really the most important thing that an investor can do is think about the quality of the assets that they're buying. So Warren Buffett describes it really well as looking for companies with a wide economic moat that sits around the business, that makes their business stronger, and then also the valuation, what you're paying for those businesses. And at the moment in the US, and particularly in large cap and particularly in technology stocks, we're seeing quite high valuations. But the good news is we're seeing lower valuations elsewhere in the US market, but also in other markets around the world.
Well, you're in Australia right now at a Morningstar conference. Now, looking at our market, the ASX 200, it's basically at an all-time record high, just a few points off. But it seems like here, interest rates won't be cut by the Reserve Bank of Australia until potentially later this year or early next year. So why all the positivity here in Australia when rates are clearly going to remain elevated for quite some time?
Well, Ed, arguably, Australian investors are doing exactly the right thing and not worrying too much about interest rates. But in reality, it might be a more prosaic answer than that. It may be just the fact that part of those gains we've seen are really from great performance by Australian financials, that the banks have done very well in a higher interest rate environment. And so that, again, has been supporting market prices. But remember, we tend to get really excited about all-time highs. We would expect the market to continue to go higher over time because as earnings pile up, as companies make more profit, as money is worth a little bit less because of inflation, you'd expect prices to go up. So it's not so much that prices are going up at all-time highs, it's the valuation. It's what you're really paying for the earnings. And when we look at the underlying earnings, when we look at what you're paying for that in Australia at the moment, it's not excessively high. It's probably a little bit above its fair value, but not enough to worry about. So actually the prospects for the Australian market as a whole and certain sectors within that look pretty attractive.
When you look at global investment sentiment, how big an X factor is the upcoming US presidential election and its ability to really affect the mood of investors around the world?
Well, Ed, with so a larger proportion of the world going to the polls this year, I think elections not just in the US but elsewhere around the world will be high up in investors' minds, and particularly as we go into the latter part of the year, as people become fixated on what's happening in the US, we can expect a lot of volatility. But what every election tells us is that if you try and base your investment policy on the election cycle, you get whipsawed and hurt, and you tend to lose money as you get pushed from one way to the other. So I'm sure that the hype and the impact on markets will increase as we go through the year. But really, investing is not about trying to position your portfolio for one particular political outcome. There's certainly no good historical guide to what's a better outcome for investors. Much better just to try and understand that these elections will cause opportunities if prices fall. They may even lead to the risk of greater downside if prices rise too quickly, if people become too optimistic. But the more we can just look through them, the better.
Well, Dan Kemp, Global Chief Investment Officer for Morningstar's Investment Management Group, thanks so much for your time today.
Thanks, Ed.